Hello, ladies and gentlemen. Thank you for joining me. It's the 2nd of March. This is Christopher Aaron, and we are going to be looking at the last 3 days in gold and silver, putting that into perspective. I first just wanted to thank all the individuals who decided to contribute to the Patron account. I very much appreciate that. I really appreciate all your support and the pledges that people have made. I'll have the link for that again if anyone else is interested, but just know that that is really appreciated as we go forward together. The second thing is I wanted to let people know an order of business. I will be attending, it's called the PDAC conference, and that is the Prospectors and Developers Conference in Toronto, Canada. That is this Sunday through Wednesday. That's the 6th through the 9th of March, again in Toronto. And this is a conference that has to do with gold and silver mining from some of the perspectives of both the investment community and the companies that are digging those minerals out of the ground. So I will be there at that, and I'm going to try to provide maybe some updates from that conference for anyone who is interested. If anyone is watching this and is going to be at that conference, it would be great to see you and meet you. So like I said, I'll be there for the full 4 days, and if you're going to be there, send me an email or a private message and we will meet up somewhere. The last thing is, on that note, this is just for anyone who's new, because I know there's a lot of new people who have been joining this channel recently, and welcome. I do have a free sub-channel that focuses more on those topics. It's more on the mining sector, which is investing in some of the equities. That is called iGold Power, and that is a little bit more boring than even some of the charts are sometimes, but it's some powerful information if you would like to do that research on your own, if you're someone that likes to learn about these things on your own. I'll have a link to all those things below. Thanks for being with me. Let's look at gold and silver this week. So I wanted to start off looking at an interesting piece of fundamental news that's been coming out recently. We had an article out in Bloomberg talking about some of the negative interest rates that we're starting to see around the world. For example, Japan has just recently sold its first 10-year bond for a negative interest rate. Now, what this means is that essentially people are paying the government of Japan to loan money to the government of Japan. This is a very rare phenomenon in the broad history of economics to see bond yields at negative interest rates. So it's one of those things that is telling us that we are in an unprecedented period in history right now we're currently living through. So there are a lot of people who maybe have just joined this channel recently that see that I tend to focus on charts mostly, and I just wanted to put this in perspective. So for example, here is a fundamental piece of news that we are following, and I do pay attention to all of the fundamentals. They are absolutely what drive this market and all markets over the long run. And for example, I want to look at how this piece of fundamental news, some of the lowering of interest rates, for example, has affected the Nikkei average in Tokyo. This is the Japanese stock market. We're looking over a period of 36 years. Let's call this more than a generation. And this is the 225 largest companies in Japan, similar to the S&P 500 in the United States, which of course is 500 companies. And we can see here that the Japanese stock market has basically been floundering for the better part of the last 25 years. Right now, closing around 16,000, down from the high of 38,000 hit in 1990. So basically, if you were a buyer of stocks at any point in the last 25 years, you are underwater for the most part. So I think it's very interesting because in this country, we are so conditioned, at least in the United States, perhaps in some of the other Western countries, we are conditioned to believe that the stock market is just going to rise if you have enough years. For example, if you just have a 3 or 5 year time horizon and you are investing in your 401k, you are guaranteed to make a return. And here we have another highly developed first world country. I mean, Japan makes some of the best technology in the world, some of the most efficient automobiles, for example. There are some other countries that make some excellent automobiles as well. But they certainly have a lot of excellent technology here in this country. But even so, their economy, as represented by the stock market, has been struggling for the better part of the last 25 years. So this just brings me to my point, which is we looked at the first article. We were looking at negative interest rates, which is a fundamental driver. And here we are looking at, for example, a technical indicator, looking at the valuation of the stock market. And so I just want to assure people again that I do follow those fundamentals. The problem is, and this may be hard for some people to believe at this point, but you cannot invest based on fundamentals alone. It's a recipe for disaster. As you know, for example, in the last 5 years, many of the fundamental-based investors have been saying a lot of these things about the troubles in the economy, yet, for example, silver has lost 65% of its value. Gold had lost 45% of its value. Those are real losses. I mean, those are serious losses. So we can't just look at what is happening in the news and attempt to invest in that way. The best analogy that I could draw would be if you're walking along a set of train tracks and you're holding the schedule for the train in your hands, and you look and you say, it's noon, there's not supposed to be a train coming at noon. That's the fundamental news. So therefore, because I know the fundamental, I'm going to cross the train tracks without looking. What if, just what if, there was something that had changed in the fundamentals that you were not aware of, and you do not look before you cross those train tracks? The oncoming train is what is actually happening in the market. The oncoming train is the equivalent of the technical analysis, the study of what the market is actually doing. And if you ignore what the market is actually doing for long enough, it is a recipe for catastrophe. So I've learned this myself the hard way in the previous decade when I first got started investing, and I saw that some of the people who were making some good calls then failed to adjust for what the market was actually telling them. And I learned that we must pay attention to the charts. As we look at the price of gold continuing to consolidate over the last 3 days, very nice, very healthy. Looking at this over the 6-month time frame, of course, using the GLD fund for anyone who is new. And we are seeing this really nicely defined triangular looking consolidation, right? We can see that. Up, down, up, down, up, down, up. So some nice hits along this lower short-term trend line as shown in the teal color. Some nice hits on this upper trend line. These look like they are converging. So what this means from a technical analysis standpoint, a study of what the market is actually doing. When I have studied these patterns over multiple markets and multiple time frames, I will tell you that this is a consolidation pattern. And across the gold market, if we are considering this to be a significant long-term low that formed above 1,045 US dollars per ounce back in December, we had an initial move higher out of that low and then a consolidation. So this would be a continuation consolidation. Now, is technical analysis correct 100% of the time? No, of course not. I would argue that except for the knowledge that we are all going to die one day, nothing is 100% in this life. So certainly I'm not saying that. However, I would say that about 80% of the time, this form of analysis helps me more than it does not. And it helps me to see the way that the market is setting up to move. It helps me a lot more than just reading articles in the news and then attempting to predict what's going to happen. So let's look at the other side of the gold market just over the 6 months. We're looking at the gold mining complex, the GDX fund, a nice break of this intermediate term downtrend shown here in the red circle. A nice strong impulsive rise higher. This was a 65% move in 4 weeks. And this short-term uptrend has broken now. One of the things that you learn when you study technical analysis is that there's a saying which is the steeper the trend, the less important the break. So when you have a market moving 65% higher in a month, which would be an annualized gain of 780%, there's a very strong chance that that is not going to continue. I mean, if it did, would I be happy? Yes, and I would be much more wealthy a year from now than I am today. However, we don't often see 780% moves in a year. So when you see a super steep trend like this that breaks, it doesn't mean that this is a top. It simply means that there's probably going to be a little bit of a consolidation before we look for the next move continuing in this direction. So that's what we're seeing in the gold mining complex right now. As opposed to this downtrend here, which was much less steep, just for reference, you can see that, right? This downtrend was lasting for several years, and it was a very shallow downtrend. And so when this broke, that was telling us something very significant, that this bottoming process had ended back here in early February. Looking at silver over the last few days, again, still consolidating right below the $15 level as we speak. Let's look at this on 6 months. This is beautiful. This is a real beautiful consolidation from a technical standpoint. And you wouldn't know this if you were just watching it from a high-level overview, but I'm glad that you're joining me here so we can look at this all together. So we had this break out of this short-term line right here, this downtrend line. So this is now turquoise. We moved higher almost to the $16 mark. Again, this is the SLV fund. So this high here was $16, even though it shows $15.20 on the SLV fund. We hit 16 and then we've been backing off since then, closing right under 15 today. Now, I've called this target higher any time now, above $16, based on the mining sector early warning indicator. Here's another indicator that just showed up today that you wouldn't see unless you look at this from the close perspective. Right down here in the lower right. So what are we looking at? This is a volume indicator. We're looking at the volume that was coming into the SLV fund today. And granted, this is a paper fund that has some claims to hold bullion. Who knows ultimately whether or not they do. That's not really that much of my concern at this point. My concern is to look at the volume that came into this fund today, which does represent genuine interest in owning some sort of a silver fund. This was the highest hourly volume spike coming into this major international silver fund in the last 6 months. The highest single volume in 1 hour. That was just in the early part of this week, right corresponding to the retest of this broken line. Very strong retest indicator that we are seeing right here. That other indicator we are looking at is the Silver Wheaton mining company that often tends to lead the price of silver, looking very good as it consolidates above this former resistance zone, kind of bumping into the resistance zone right now. That is perfectly normal. We don't want to be too strict with these lines as we draw them, the black horizontal support and resistance lines, or else we can easily miss the message of the market. Then again, we don't want to be too loose, because then we just have no idea what trends are really developing. So there's part of an art in this as well, getting the pulse of the market. In summary, these extremely healthy consolidations with ample early strength indicators are looking very good right now. I would not be surprised to see, in fact, I expect to see the price of gold and silver moving higher at any point. It could be tomorrow, it could be 4 weeks from now, it could be 8 weeks from now. But I think we are setting up to see the next move higher. And from a psychological standpoint, this is actually really perfect right now, these consolidations. Why they are so healthy? Because everyone who got interested in this market 4 weeks ago is now, well, a significant portion of them are starting to lose interest. And that's what happens to form these consolidations. So it's very healthy that many of the people became less interested now. And when the next leg higher rises, there's going to be a whole new wave of people that come in and say, wow, that first move off of the lows was not a fluke. Thank you again for watching. The next update will be on Sunday evening, as long as everything is working well from the PDAC conference. I will have that upload from the conference there in Toronto. Thank you for being with me.